Good afternoon, and welcome to another edition of Unlock the Stock. We really are pleased to welcome back Pan-African Resources today as a returning company to the platform. As you know, this Unlock the Stock platform is specifically designed for retail investors to gain access to management and to get to know them and their companies just a little bit better. Cobus Loots, the CEO, and Hethan Hera, the IRO, join us today and will take us through a presentation shortly. Unlock the Stock is only possible with our technology partners, Lumi Global. Their website is lumiglobal.com, and you can learn more about their various online AGM and investor presentation solutions. Our host today, as usual, will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they'll be facilitating the Q&A session at the end of the presentation. But before we start, there are just a few housekeeping notes. Cobus will take you through a presentation shortly, and that will be followed by a Q&A session. You can post your questions by typing them into the Q&A box, which is at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel next week. You will see an email address when we start the Q&A session, which will have an email address for Pan-African Resources. So if you want to be added to their contact database, please just jot down that email address, please. And with that, Cobus, I am ready for you to share your screen and take us through the presentation, please.
Thanks, Vanessa. Thank you for the opportunity. Obviously, we have the disclaimer and forward-looking statements, as one always does. An overview of the presentation. Let's just get right into it with health and safety. And we always say we can't operate and mine if we can't do so safely. We're very proud of our safety record, and we continue to work at improving this further. Obviously, the fact that we have such a large proportion of our production from surface, that helps us inherently safer. But we also fortunate in that our mines, both Barberton and Evander, does not have an awful lot of seismicity, so that allows us to operate very safely and be an industry leader. Also, we don't have thousands upon thousands of people, and that means we can be very focused in terms of what we do from a safety campaign perspective. So very, very happy with the record, and we continue to work to improve further. In terms of an overview of the group, it's quite a unique proposition, we think, of underground mines, and then the surface remining, which clearly, with the commissioning of MTR last week, will continue to be an even more important part of our portfolio. But yeah, basically we Barberton Mines Complex in Mpumalanga, the Evander Mines Complex in Mpumalanga, and then our MTR operation just an hour or so outside of Johannesburg. Also, this is something that we think the majors can't really replicate. Obviously, gold production was up quite nicely in the year that's passed, and with MTR now coming on stream, we're going to grow production by some 25%, and also quite a decent mix of, as we said, surface and underground, which is fairly unique. So about 35, let's say 40% of production now from surface. We have Mintails, we have Elikhulu and the BTRP, and then we have the underground mines at Evander and also at Barberton. And it's quite an interesting theme, I think, in the sector at the moment. You've seen cost escalations, capital escalations. Many of the miners, in our view, have underspent on capital and development over the last 10 years. They have to play catch up now. It's not the case with Pan-African. We've invested a lot into our portfolio, and we're very much poised to start reaping all of those benefits now in the years ahead. Everybody's familiar with the South African operating environment. Obviously, a couple of positives is, I think, a lot of improved investor sentiment following the successful elections in May. We haven't seen load shedding for some time, which also assists. The grid has been fairly stable. Pan-African, and there is a slide on this. We sort of view the whole energy situation also as an opportunity. We were the first miner to commission large-scale utility-sized plant at Evander. We followed that with a 9-megawatt plant at our Barberton operation. and we've signed a power purchase agreement, and we'll do quite a bit more in terms of expanding that footprint. And that really makes us more competitive. On our first phase at Evander at this point, we're saving some 4 million rands a month, which is not insignificant because of that investment into solar. Our mining rights are secure. Stakeholder engagements, I think very positively, multi-year wage agreements in place. We signed a 5-year deal at Barberton earlier this year, very positive, at pretty much inflation-linked numbers. And yes, I mean, very much in terms of our views, beyond compliance initiatives to maintain our social license to operate, illegal mining continues to be a concern. And we have a number of initiatives and plans in place to successfully manage the continuous onslaught, certainly at this gold price at our operations, and specifically at Barberton. And just the last comment on this, it does feel like the sentiment towards South Africa as a investment destination, specifically for mining, is improving. There's been a lot of also relatively negative developments elsewhere in Africa. There's sort of talk over the weekend of mines being nationalized in Burkina Faso. It was sort of clarified afterwards. But, lots of challenges in Africa, and one has to take a step back and say, Pan-African has such a long and successful track record operating in South Africa, and we still think there's quite a lot of scope to grow and do more things. And relatively speaking, we think South Africa, if we communicate the message in the right way, will attract more international investment. Key features from the last year, just come back from our roadshow, and it was a decent year. So gold production was up with continuous operations at Fairview, specifically having a positive impact. Costs were well controlled, pretty much on guidance. And excitingly, from a cost perspective, with MTR, Mintails now being sort of a producer that's going to produce at sub $1,000 an ounce. So it's going to reduce the whole cost profile for the group. I think that's quite attractive. And then given the gold prices and the operational performance, we had a very good year from a earnings and a balance sheet and financial statement perspective. Importantly, I think the gold price only really started running in March. So, given where things are now, clearly, we can expect to have even further improved results in the year ahead. The next slide just sort of demonstrates also how nicely our margins have expanded over the last years with the increase in the gold price, and then also the initiatives that we've undertaken to expand our production base. So that's quite attractive. If we go then an overview of the group per operation, firstly, Elikhulu, which up to now has been our flagship tailings mine for operation, exceptionally successful, commissioned 2018, repaid the $120 million of upfront capital in about 3 years. And yes, Elikhulu at this gold price is generating very attractive cash flows. We still have 9 years of life remaining with fairly limited capital. So Elikhulu will continue to contribute and be a very attractive part of the group for many more years. The BTRP, which is it was actually our first gold tailings operation that we commissioned at Barberton in 2013. It was some $30 million at the time, and it paid itself back in 18 months. So for some years, we've been flagging the fact that the BTRP is running out of feed, unfortunately, and that we would have to repurpose the plant as a hard rock plant to treat material from our Royal Sheba and our Sheba Fault projects. But now, positively, we've done quite a bit more work, and we've managed to extend the life of the BTRP to some 7 years. Clearly, the cost will go up, but still we'll be producing let's say between 30 to 15,000 ounces for 7 years at an all-in sustaining cost of some $1,400, which is very comparable with the rest of the global sector. So that's a big positive for the BTRP, and hence the BTRP will continue to be an important part of our tailings retreatment portfolio for many years. Then excitingly, MTR. The MTR, it's no longer a project, it's now a mine or a remining operation. And I spoke about South Africa as an investment destination, but excitingly, I mean, we built all of this. It was a 2.4 billion rand, 130 odd million dollars of capital that we put into the ground in 14 months. The life of Mogale only will be 13 years. But if we include the reserves we had at Soweto, that'll be more than a 20-year life, producing between 50 to 60,000 ounces. Our budgets for this year expect an all-in sustaining cost of sub $1,000, which is world-class. And definitely room to expand this further. If we can secure some more tailings in that part of the world, which we think we can, there's scope actually to look at a separate standalone plant at Soweto as a further expansion. So this really is a huge success story for Pan-African, and I think for the area and for South Africa. And I mean, very much demonstrating we're on track. So we've commissioned, and we'll have steady state production by December. And then, I mean, obviously also huge positive social and environmental aspect to this project. Most of the workforce, as of last week, we had about 1,600 people on site. From a safety perspective, we haven't had one lost time injury or one reportable. And when we steady state, which will be in the next month or two, the number of people will reduce to 500, but mostly from the local communities, people that had no prospects before. And then environmentally cleaning up the area, rehabilitating and repurposing land, and then everything else. So quite exciting. And just talking about our track record of tailings, it's just been a very successful business for us, starting with a BTRP and now culminating in the MTR. And there's, again, we think there's scope to further expand on this in the years ahead. If we then move on to our underground mines, the Evander Underground, it's one of the largest underground ore bodies still remaining, even though there's been 10 shafts that have been sunk in this Evander basin over the years. We've spent most of the capital now. It's just sort of getting ourselves ready to produce and expanding the production profile out of the 8 shaft operation over the next years. We were a bit late with the vent shaft. We almost now commissioned, and then you'll see a huge uptick in production from the Evander Underground. And there's scope to expand further on the Egoli project, which is off 7 shaft in the years ahead. Barberton, which is where all of it began for Pan-African, building more flexibility into Fairview. It's a decent performance from Fairview with continuous operations that we implemented in 2023 now, really assisting us. So I think that's quite attractive, and definitely significant further exploration potential in the times ahead for Fairview. The smaller operations at Sheba and Consort, it's not a huge chunk of our production, but they do require work, Consort specifically, and in Sheba. So Sheba definitely performed better because of the continuous operations, but we believe that there's still further scope here to improve things, certainly from a Sheba perspective in the years ahead. Group all-in sustaining cost. So a large chunk, 80% of our portfolio produced at a very attractive number. Sorry if I just go back there. And then the high cost operations, specifically Sheba and Consort, sort of breaking even at this gold price. But again, we think there's a bit more scope. If we compare ourselves in South African mines, we're known for being high cost, but certainly as Pan-African, when we compare ourselves with a global space, I think we compare very well. As I said, you've seen big cost increases globally, and when costs go up, they don't come down. We have the benefit now of further low-cost production from MTR that will assist us into the future. But we compare very well. Capital projects, as I said, this will be the last year of such large capital with MTR, and then the investment into the Evander Underground, and then that capital comes down. And we've continued to reinvest and grow our business through the cycle, which bodes well for the future. Just very briefly, ESG, our beyond compliance approach. All of our rehabilitation liabilities other than MTR are funded in terms of investments. MTR, by actually processing this material, will reduce the liability to about 25% of what it is currently. So there's the ability to build it up over many years. I've spoken about our renewables energy initiatives. Water recycling, we'll look to double the water recycling that we do at Evander in the next year or so. Use pretty much no potable water. And then just huge positive impact where we operate in terms of employment, economic opportunity, building schools, clinics, and everything that we do that I think miners generally should promote even more than what we currently are doing. And again, just our pipeline of renewables growth. It's quite conceivable. We think that in the next, say, 2-3 years, we could source almost 50% of our power requirements from renewables, which I think is quite attractive from an ESG perspective and also from a relative cost perspective, where the rest of Africa burns lots of diesel running yellow fleets of equipment. Not the case with Pan-African. Won't dwell on the financials. Suffice to say, it was a very good year from a financial perspective. And then historic and current dividend yield, quite attractive, pretty much industry leading in our minds also. It's a nice dividend that will be paid to shareholders sometime in December of this year again. Focus very much also on capital allocation as management team. The temptation is to do a lot of M&A now, and you've seen some M&A in the sector. We don't have to go do anything large because of our internal projects that we have. I mean, the M&A that we do, I think we have a good track record on MTR. We went and paid just over $1 an ounce recoverable for these ounces of MTR. Those are the sort of deals you want to do. So we're not under pressure to do anything. Our production, just with our current pipeline, is one where we're increasing production versus some of the other guys that are falling off a production cliff in the next year. So I think we're in a good position to continue to give our investors a sector-leading return on equity. And then to conclude, I mean, very much just focused on delivery, optimization, and improvement initiatives. We've commissioned MTR. That's very exciting now, ramping up. Obviously, renewable energy is continues to be a focus. And then sustainable shareholder returns, and continue to look at further ways of growing in a responsible and circumspect manner. That is the Pan-African Group. Thank you very much.
Thank you so much, Cobus, for that lovely presentation. You always talk with a lot of confidence. You've got very exciting projects going on. So without dwelling on this, I'm going to hand you over to Mark and the finance ghost to take us through the Q&A. And just as a reminder to those on the call, please type your questions into the Q&A box at the bottom of your screen. Thank you.
Thanks, Vanessa. Thanks, Cobus. Cobus, you touched on kind of a lot of my questions, but maybe if we can go deeper into them. One is, you're talking about the gold price. It's kind of ran in the last 6 months, and I read a lot about the amount of buying that like the central banks are doing, and obviously with their balance sheets, they are significant customer in the gold space. But have you heard what's like kind of driving this like supercharged demand from the central banks? Has the World Gold Council come out with any research on it? Because we know there's a lot of retail buying as well, but I mean at the like big end of town are also doing a lot of buying, and I'm just wondering, is there any research to say why, or if we could kind of expect a step change up or down in kind of that central bank allocation to gold?
Yeah, it's an interesting one. I mean, if we knew what the price would is going to do, obviously, like we wouldn't be mining. Then it would be a lot easier just to buy some options or sell options or whatever. But broadly, it feels to us, and obviously we have the benefit of speaking to a lot of people in the sector. Now, I mean, gold is a currency. That's basically what gold is a currency that people mine. That's it's not a commodity generally that people consume, or that has huge industrial uses. So gold's a currency and it competes with other currencies. And our view is that, I mean, the central banks definitely, there's been huge buying out of China and out of the Middle East and out of other regions. And it speaks to the general theme of de-dollarization that's happening in the world. Nobody will talk about it directly because it doesn't suit anybody to have their dollar reserves devalued. But that's effectively, in our view, what's driving a lot of the price at this point. interestingly, you've seen until recently, there's actually been redemptions and sales from the ETFs, but most of that gold's been picked up by the central banks, and we think there could still be quite a lot of room for gold price movement. Obviously, the social political situation in the world drives the gold price over the short term. Doesn't feel like it's going to be sort of massively stable in a while ahead. And if you look at the proportion of gold that is held by, call it, your traditional Western investors, it's very, very small. It's 1-2%. So, I mean, even if you just have that double, that's a huge impact on the gold price. So it does feel like the gold price might still have some further room to run.
Yeah, I mean, I'm an F&B customer, and I got an email from them saying, they're seeing record demand for Krugerrands like through the F&B app and stuff like that. And I mean, I spend a lot of time in Australia, and similar stories over there. The Perth Mint struggling to keep up with the one ounce kangaroo coins over there. So I mean, even on the retail side, while it's not massive, there is like very strong demand, it just seems, across the board. I'm going to get one more question in before I maybe get the ghost in here. We've seen share prices run, especially in the producing side of the gold space. They're kind of reacting to the higher gold prices, and despite costs going up, the margins still look good. But the junior space hasn't seen that. If you're not in production, there's kind of nothing happening on the share price side. But does that throw up opportunities for people like Pan African to pick up assets or tenements or near-term production, or maybe not near-term, maybe 5 years out from production kind of thing, where they're at bankable feasibility stage assets for you guys? Has it thrown up any interesting juniors
Sure.
that look attractive?
So, I mean, this is a dangerous time to be doing M&A, very dangerous. And, it's easy for investors to be cynical, but I have a lot of respect for the views and the sort of general sort of investors. And I mean, you make an interesting point. The share price of companies have definitely is done well, not as well as generally the gold metal. And investors still remember sort of the huge, call it, wastage on some of these M&A deals, which have not been accretive at all. And I think there's still concern in terms of investors on capital allocation from companies when things are going well. My management teams go out and they blow the windfall on doing like what are deals that just shouldn't be done. So from our perspective, as I said in the presentation, we're in a good space where we don't have to do any sort of transaction to maintain and grow our production profile. If we go do something now that's 5 years out, I promise you our share price is going to go down. The only deals we could do is something which, if not in production, is like imminent, and certainly you can't slot in the current gold price into that. That obviously then makes that sort of call it the likelihood of us doing something large. I just can't see it happening. Investors, again, like if you think about when all of these Wit shafts were sunk, guys were happy to wait 10 years for a return. It's just no longer the case, and you have to listen to your shareholders. People want to have short-term returns, and I mean, we continue to invest into our business for the long term, but we can't do something that's very dilutive, and that's why we have managed to sort of do our continue to have a sector-leading return on equity. And I did see a question on whether the focus from our side is more on surface versus underground. Look, I think the surface business has done incredibly well. We're excited about the future of the Evander underground. There's lots to do there, as there is with Barberton. But let me be honest with you guys. I mean, it's a lot easier and a lot more stable mining on surface. That's a fact, and lower cost. So we have our underground mines, and we'll make those mines work, and we'll make those mines generate returns. We're not repositioning ourselves as solely on surface, but to be honest, there's no underground mine that I would want to buy at this point that I can see that we don't have within our own portfolio.
Okay. Let me package out one of the audience questions, but let me hand over to the ghost here to see if he's got one or two maybe in his DMs.
Yeah, thanks, Mark. Thanks, Cobus, as always, for joining us on this. And to everyone attending, please remember to send through those questions. Yeah, you've preempted one of mine there, which was around surface level versus underground mining. So I think that one's pretty much ticked off. I mean, the benefit, and I always love using this as an opportunity for people to just learn more about mining, myself included. Much as underground is riskier, I mean, the benefit there is life of mine, right? It's typically a longer term. I just want to confirm that so people understand the difference between surface level and underground, because, it's always a trade-off, right? There's nothing that is going to be completely perfect, because otherwise that's the only thing that anyone would do.
Sure. Look, gold is, I've come to the conclusion after many years that there's a reason for gold being so precious. And that one of the reasons is it's so very difficult to mine profitably. Yes, I don't mind. I think we have a nice portfolio, and some other companies in the past have limited themselves to surface. We think we're decent underground miners, but I'll be honest with you, underground mining is more difficult and it is more volatile. And that's again where I think our portfolio is a really nice one, where we have now, if we take MTR, if we take Ilukulu, and we take BTRP, we have 100,000 to 120,000 ounces on surface for the next 10 plus years at an all-in sustaining cost of $1,000 or below. That's a nice business. And that means we can stomach a bit more volatility on the underground, do some more development, but it comes down always for us ultimately to the return. And that's why, we're happy. I mean, we've invested into our Evander gold mine. We on the cusp now of reaping the rewards. And, Barberton continues to, it's been mining for 140 years. It'll be probably the last mine to shut in this country. So, it's a nice, and from our perspective as Pan-African, we have, in our view, good expertise on surface remining, open pit remining, metallurgy, underground mining, geology. So, we're not going to close ourselves to any opportunity. But, we also look at these things a little bit differently. In terms of a big thing for us is payback. How long does it take conservatively to get our cash back? IRRs and all these things are great. But, we recently looked at a project with a fantastic IRR, but the payback was 8 years. It's like, it doesn't really work for us. You look at Mintails or MTR, the payback at this gold price will be sub 3 years on $135 million on investment. Clearly, you don't get many of these opportunities, but we can afford to be selective.
Cobus, maybe if I can just have a follow-on to that, because it's very interesting to hear you talk about the M&A strategy and things like payback period versus just IRR, etc. Now, I appreciate your comments around, the M&A approach that you take. And I think you talked earlier about how a lot of mining companies take their windfall and they go and do big M&A when they're not supposed to. And you're absolutely right. Obviously, that's a feature of the sector, unfortunately. Not necessarily just gold mining, but the broader sector as well. Do you think that this sort of risk-weighted approach to M&A and your somewhat conservative view, is that a Pan-African Resources culture thing, or is that feedback from your investors to say, just keep doing what you guys are doing, we're happy, don't go and bet the farm on anything? I'm just wondering where that's coming from. Is that an internal approach, or is that feedback from the market, or both?
Well, look, both, our previous financial director, Dion, that worked with me for many years, and we worked together in the chair for 10 years, and we both finance guys, and we're quite conservative. We've been all over Africa, and we could have done so many deals, generally these things don't stack up. If you say you go into West Africa, you pay, these are ballpark numbers, $150 million for 1 million ounces on surface. And then you have to spend $250 million on developing your infrastructure. You're in for $400 million for, let's say, 100,000 ounces of production at 1,200, 1,300 all-in sustaining. It's just difficult. You can't get your 20% return. So, there's two deals in the last 10 years or last 12 years that we regret not doing. The rest we're quite happy we didn't do. And yes, our shareholders are fairly conservative. Some years ago, one of the largest shareholders said to us, guys, just go sit on the beach. Just don't do anything. It's not quite accurate, because you can't, you have constantly have to deal with problems and issues and opportunities. But like, again, we're in a fortunate position where, we have such a lot of optionality in our own portfolio. And MTR's opened up now a third large opportunity for us. And so we look to consolidate around these assets, these complexes of ours, where we have all the people and expertise and facilities. It's not to say that we won't do anything, but certainly, are we going to do like something on 20% of our market cap? Do we need to know? And we have to be very, very sure that we're going to get our 20% return.
Cobus, if I can just touch on one. You talked about the artisanal mining there, and the problems that causes. And post the election in this new GNU period, we're all in. Has there, we've heard noises from other companies, especially at Transnet, that okay, things are not going great there, but there's at least a willingness to try and sort things out and improve things. Eskom seems to be kind of holding its own for the last couple of months. But on the securities side, have there been, any appetite post GNU to engage with, the broader industry on this whole artisanal mining problem, to try and help out industry or work together with industry more closely than maybe has happened in the past to try and resolve the problem or get it more under control? Maybe resolving might be a bit too far of a stretch.
Yeah, I think, let's be clear, let's call it illegal mining, because that's what it is in the South African context. We don't really have artisanal mining. We, as Pan-African, have a very good relationship with the police. And one has to understand the police are under-resourced and under-skilled and overworked, and it's very difficult for them. So we try and assist where we can. And an example of successful cooperation, I think will be the MTR site, which we have this huge concrete wall around the site. But walking around there, one feels safe. And this was the site before we got involved. You might remember there was an atrocious sexual assault case. And it was really the Wild West. But I think this is an example of what we can achieve, industry and law enforcement and other positive stakeholders working together. Definitely there needs to be more work done. Barberton at this point, we have excellent people and we have excellent systems and we use technology, and that's how we keep the situation under control. If we were to take our foot off the gas, that whole area would be overrun in a question of weeks. So it continues to be an area of concern. We have it under control, but it's important, we think, for government to do more. And in terms of doing more, we're talking minimum sentences. We're talking sort of a really concerted effort to address this issue.
Mr. Ghost?
Yeah, I'm going to jump in with another one. I quite enjoyed the artisanal mining reference, Mark. I think there's a future for you in marketing. taking some bad things and giving it a nice spin. No, I'm just kidding. I think, Cobus, mine is another more sort of general mining question. As I said, I always love learning these things from you, and I think for the listeners, often people are just too scared to ask questions that seem obvious, but I feel like they're nuanced. And this one is just surface mining versus tailings. How are those things different? Like, just high level for people to understand that they're not necessarily the same thing.
Yeah, so surface, tailings, you treat legacy tailings that were generally from underground. That was sort of the product in South Africa of more than 100 years of large-scale mining. And obviously, you've seen the Johannesburg skyline change over the last 10, 15 years, where a lot of these tailings facilities have been retreated and redeposited elsewhere. In a way, it's quite sad, strangely, for somebody that grew up here to have seen it happen, but it's important. It's important for rehabilitation. And then we talk surface, so that's surface remining or tailings retreatment. And then you have open pit mining, where you're mining ore bodies from surface, generally with big fleets of yellow equipment. That in the gold space, you don't find often now in South Africa. There's one open pit that I know of scale, which is Cal Gold. Nobody else really. The other mines are either tailings retreatment or underground operations.
Cobus, if I can just ask one, going back to another feature of mining is hedging. Hedging gold price, hedging FX, and maybe just talk to us about how you tackle that. From a pan-African point of view, because the gold price, as we know, swings up and down. The currency swings up and down, but you've got like costs that has to be
Sure.
paid, and shareholders who want kind of dividends. And capex requirements. So, it can play havoc on your cash flow if you don't have the kind of hedging in place. But maybe just talk through the kind of basic philosophy of like how you look at hedging in order to dampen down that volatility, ensure you have the cash flow when you need it.
Yeah, so that's an interesting one. And in the past, it's not really in a management team's interest to hedge. Why I say that is, if you get the hedge right, then people say, well, you got lucky, and I accept that 100%. But then if you get it wrong, everybody is incredibly unhappy with you. So no management team, in my experience, gets fired for not hedging. So it's quite a brave thing in a way to do. Specifically, also, you'll remember in the 90s and early 2000s where you had these hedge books underwater, and it just was a disaster. So that's not to say that in our view, there's not a place for hedging. So when would you hedge? You hedge when you have large capital to do, or where you have your dividend to protect, or something similar. So if I look at Pan-African, we will never go into long-dated hedges. Those generally don't work out, and we don't look to hedge a large chunk of our production. We had to, unfortunately, to secure the final 400 million rand for the construction of MTR. We basically had to forward sell some gold, which is like annoying us big time at this point, because we are on about a third of our production. We're not getting the spot gold price. We're getting about 1.15 million rand per kilo. But luckily, that hedge runs out in February, so it's only 3 or 4 months to go. And I mean, the alternative would have been to raise equity. This is still a lot cheaper than raising 400 million rands of equity if you look at what the share price has done. The other structures we would do is short-term collar structures, where you sort of do a floor, and you basically then only give upside away. Currently, you can go do a floor, say, for 1.4 million rand a kilo, or 1.35. The spot is about 1.5. And you can only, this is 12 months, and you're only going to give upside away at 1.8 million rand per kilo. So those are quite attractive levels. We have some of these collar structures, but nothing that at this point is preventing shareholders from getting the spot gold price. So most of our shareholders invest in Pan-African because they like the gold price. They want exposure to the gold price, and we need to recognize that and give them that exposure, but with the caveats that I've mentioned.
So with the capex coming down then from next year, that hedging of the production is also going to start coming down as well, because you don't have such large commitments that you can see kind of down the pipeline on various projects.
It's quite conceivable, and so again, to be clear, we only have this one fixed price that we're receiving on about a third of our production in February. For the rest, effectively at this point, there are no hedges. Another point also is, if you look at our cost of production, all-in sustaining cost, I think our guidance for the year ahead is about sort of between circa $1,350 an ounce. So we're quite low on the cost curve. Again, it means that we can afford to give our shareholders the exposure to the gold price. So I'd be quite surprised, actually, if we did any further hedges in the short term.
I think something else you obviously have to think about operating in South Africa is obviously Eskom. It's amazing how load shedding has just gone out of our vocabulary. I barely ever see it in SENS announcements anymore. I mean, I suppose we'll never truly know what happened there. But anyway, it seems to be gone. Nonetheless, solar remains a bit of a focus for you guys. And obviously, power availability is a nice risk thing to try and mitigate. But there's cost savings as well. And I think for the renewable energy enthusiasts, it's quite good to understand, what do those cost savings look like? Is it very much in the maths now, where you can justify these projects regardless of whether Eskom's working or not?
Yeah, so very much so. Look, if we had the capital to build behind the meter solar for all of our operations, from a financial return perspective, I believe we could justify doing so. That's how attractive it is. You've obviously seen increases in the cost of these facilities, but then the cost of panels and batteries are also coming down. Your biggest challenge is that you're operating in an uncertain regime where you know that because of what's happening in the private sector, Eskom's going to change its tariff regime, and they're going to charge you more for using their network. So that you have to factor into your calculations. That's why you don't have to want to get all your power via wheeling, and you have to be quite selective. This is a long discussion in itself, in our view. You have to be very selective. Do you go wind or do you go solar? We have our own views there. But certainly behind the meter, solar and potentially now battery energy storage, we think makes a lot of sense. On the first 20 megawatts that we have installed, the monthly saving is in the order of 8 million rand, which is not insignificant. So we'll continue to expand on our renewables footprint. In the short term, we need to get our good friends to build this 40 megawatts we've signed up for. And then in the next 2 years, we'll look to do probably 20 megawatts of solar behind the meter at MTR and another 20 or so at our Evander site.
Got a question here that I suspect I know the answer to, given your conservative nature, but are there any future plans to diversify the business away from gold?
There's no reason. I think this is something we've also seen in the last 10 years. Investors, unfortunately, their attention span, it's probably a product of everything else in the rest of the world. Everybody's attention span has reduced markedly. So trying to explain to investors, oh, we have gold and we have this and other commodity, just it gets too complicated, and within a couple of seconds, people's eyes glaze over. Why have some of the gold guys gone into copper? Because you find gold copper together often. But then importantly, I think it also speaks to the fact that there is actually no or very limited opportunity to look to grow in gold. If you look at when last you had a major development or discovery, it's few and far between. So the big guys, in order to try and maintain their size, have had to diversify into copper. But look, we have more than enough to do in gold. If we got a remarkable tailings opportunity in copper or PGMs, maybe we would have license to do so, but we just generally don't have. It's not really on our radar at this point.
Yeah, that was the answer that I was very much expecting. I wanted to ask you just around some of the, industrial action we've seen of competitors. Well, I mean, let's call a spade a spade. It was mainly Sibanye that had a bit of a nightmare in their gold business around industrial action. How do you guys manage your risks in this regard? Just, because the whole story that I'm hearing is very much that Pan-African is just super solid at the moment. Really good outlook for the next few years. You don't have to do anything crazy. So, just trying to get down to where the risks still potentially lie in this thing. Obviously, the gold price you can't control at all. That stuff like industrial action, what are the mitigating steps you've got there?
Fortunately, we don't have tens of thousands of employees, so we can be very focused on managing that relationship. Barberton, we signed a 5-year deal earlier this year. It tells you something about the good relationship we have. And I mean, we've seen, actually, I think labor relations have improved over the last couple of years, where people and miners recognize, hey, this is a tough economy. We really are doing well. We be well paid. We well remunerated. Let's not rock the boat too much. So I think positively we've seen that situation improve, and we've never had major long-dated industrial action. That does happen. In July we had unprotected industrial action at our Evander underground. Took us about 3-4 days, and we sorted it out. But one has to draw the boundaries, and you have to be quite firm on how you engage when these sort of things happen. But I mean, we're fortunate. I think we have good people in our work looking at industrial relations, but we also have good workers.
Let's move on to some balance sheet stuff. I mean, your net debt has moved quite a bit higher, but your dividend is also a fair bit higher as well. I think just for investors to understand how you think about managing capital allocation across, debt to equity, for example. I mean, it looks like you're not shy to take on, for that debt to tick higher, but for the dividend to keep being a consistent part of the story as well.
Yeah, it's look, we generated sufficient cash from our operations to pay the dividend, and the reason for the increase in net debt is obviously MTR. If it wasn't for MTR, then we'd have very limited, pretty much no net debt at this point. So we don't particularly like debt. Miners shouldn't be overly geared, but for the right project where you're going to sort of pay back this money in 2-3 years, it makes all the sense in the world. So yeah, we don't want to go gear ourselves significantly more than what we are at the moment.
Yeah, that makes sense. And then in terms of the rand, I mean, who knows where the rand goes? Obviously, it does thankfully seem to have gotten a fair bit stronger than it was under this GNU, and obviously rates coming down overseas and all these wonderful things. What does a stronger rand potentially mean for you? I mean, it would theoretically mean a lower rand gold price, although you can never assume that gold only moves with the currency. Obviously, it moves for a million different reasons.
Sure.
Do you have, for example, any dollar-denominated expenses that then become a bit cheaper in the business, or is it really just the gold price that you're exposed to when it comes to the rand?
95% of our costs are rand-based. And we don't have any major capital projects now where we exposed to the US dollar. So I mean, generally it feels like obviously the rand's strengthened, and that's, you don't want a currency that's too weak, and you don't want a currency that's too strong in our view. I don't mind it. We don't mind it where it is at the moment. We still at a really attractive gold price in rand terms, and that's obviously the way we think about it. And to take a step back, if we did hedges, we always cover both the dollar gold price and the dollar rand. So we hedge in ZAR effectively, because again, that's what our cost base is. So I mean, I don't think, and this is a dangerous prediction, but I'm not sure how much more legs the rand has at these levels, or even at a 17 or whatever. We still receive an excellent gold price in ZAR terms.
Yeah, then I think just last question from my side, unless anything else pops into the DMs in time, but otherwise we'll call it there. I guess just any views on kind of conversations you've had with investors. This obviously, the whole GNU upswing is on everyone's lips. Load shedding seems to be gone. A lot of JSE mid caps have rallied really strongly. The mining, obviously, it's a bit different because it's very linked to the gold price, but it's also very driven by sentiment as well. We've seen some big transactions from gold mining houses to try and go rather look for money overseas, try and get that international valuation versus local. From where you're sitting with such a strong return on equity, very strong SA focus, the conversations with investors, would you say that there has been an improvement in the behind the closed doors conversations and sentiment in the past few months? It's not just the media headlines. Is it real back there?
I think it is. I think there's also appreciation that, relatively speaking, to the rest of Africa, and let's be honest, I mean, the world's not in a great place. Everywhere has its issues. I mean, we just haven't done ourselves any favors over the last 20 years in how we've communicated our investment proposition as a country.
Mm-hmm.
Yeah, but like, I mean, and to Hayton's point, I mean, a couple of weeks ago we got into the GDX. That's 5% now owned by Van Eck. So we've always worked hard on the international register. So I say circa 40% of our shareholders are offshore. I understand South Africa. They're very comfortable with the situation. And yeah, it does feel like there's more positivity. There's a question here I also see from Mohammed to say, like, gold price, like the GDX hasn't rallied to the same extent. That I think speaks to, again, like, investors not trusting management teams to allocate capital correctly. But I think in the past, you've also seen the gold price rally before you see the miners really rally. Hopefully, we still see a bit of a rally still in the equities.
Cobus, thanks. I think that's been a really, really good session. Much appreciated. And yeah, Vanessa, I think over to you.
Thank you so much. Thanks, Cobus. Thanks, the Finance Ghost. This was a really lovely session, so thank you very much. To everyone that's on the call who made time to join us today, thank you. But a real special thank you to Cobus and Hayton for coming back to Unlock the Stock, and all the best for the year ahead and everything that you guys are doing. So we hope that everyone that's on the call has enjoyed the session. And as a reminder, it'll be on our Unlock the Stock YouTube channel next week. Our next Unlock the Stock session is on Thursday, the 17th of October, and features another returning company, which is Calgro M3. And in November, we're going to feature TWK. And then to close out the year, in the first week of December, we have the KAL group coming to talk to you guys. So that's a new one. That is all from my side. Thank you very much to everyone, and goodbye.
Thank you. Bye.
Bye.